Hi guys, and welcome to Cultnomics. My name is Paul Hanley, and today I'm going to be chatting to you about an introduction to the government budget. In this video, we will look at the government budget and how this relates into fiscal policy. We'll look at two aspects of this budget. We will first look at the budget balance, which is the overall difference between government revenues and spending. So this is the difference between what a government takes in tax revenue and what it spends on big items such as education and health. This can be in surplus or in deficit. The government can have a positive balance on it or a negative balance, depending on the balance of revenue and spending. Mainly, governments have a deficit, and a budget deficit occurs when the amount of money a government spends exceeds the amount it receives in taxes over a given time period. This happens quite often as governments exceed their budget and spend more than their tax. If this accumulates over time, it becomes a national debt, which is the total sum of money a government owes at a particular time. So this is accumulated debt over time, which sometimes can rise to excessive levels, which can hinder a government from borrowing day to day. Now, what does the government actually spend on? Well, we usually refer to this as the big three. And the big three start as follows. The biggest expenditure item usually for a government is social welfare. So this is, for example, unemployment assistance, carers allowance, etc. The next big one would be in terms of the health budget. Spending on nurses, consultants, on the actual infrastructure, the hospitals themselves. And the third biggest one would be education, usually spending on third level, second level, primary, etc. So they're the big three in terms of expenditure, but how does the government actually generate a revenue to pay for this? Well, one of the big revenue generating items is income tax. So many incomes, especially those that are employed, are paying a lot in terms of income. They are also paying tax indirectly in terms of tax on goods and services, value added tax sometimes it's called. The government generates tax through corporate tax rates on firms' profits and capital gains as well. And it also taxes property and wealth at times. So we have property taxes in the modern economy. So all these provide a source for government spending in an economy. Automatically, a government will go into a deficit situation in terms of a recession because it will spend more in the economy and take in less in tax with higher unemployment rates. So automatic stabilizers come into play. However, there is such a thing as discretionary fiscal policy as well. And this happens when the government deliberately changes the stance of fiscal policy by changing its tax rates, the level of social welfare benefits, and the level of expenditure on goods and services. I hope you call back to Cultnomics soon. Bye for now.